all we're doing here is we're comparing buying the call option versus selling the call option. And really the biggest two things I want you to notice is, one, in 3 out of 5 scenarios when we buy the call option, we lose money. Which means what to us now? Which means in 3 out of 5 scenarios when we sell the option, we must be winning money. And that's exactly the case. The other thing I want you to notice is this break-even price scenario. So here's the break-even price. It's the same for both. But what does that mean? Well, in the case of buying the option, what happens is, here's where the price starts, right? Stock price doesn't change. So we're starting the price here. What it means is the stock price in the next 34 days has to go all the way up to this break-even price just for us to break even. It's got to go all the way up from 1218.80 to 1260.55 in the next 34 days, which is a total of 41.75 increase. It's got to go all the way up to here just for us to break even when we buy the call option. Okay, so what does that mean when we sell the call option? Well, remember, when we sell the call option, we want the price to go down. So in this case, it's the exact opposite. Here's where the stock price is. Here's our break even. As long as it's below this price, 1260.55, as long as it's below this price in the next 34 days, which means anything below 1260.55, we actually end up making money. So hopefully now it also makes it a little more clear as to why our chances of winning or making money are so much better when we sell versus buy. So all this leads us to rule number 1 of trading, which is our most important rule we need to know about trading. And that is, if we can win more money than we can lose, our POP is always less than 50%. Always. Which means on the flip side, if we can lose more money than we can win, our POP is always greater than 50%. So in the case of buying a call option, remember, we have limited loss, what we paid for it. We have this undefined profit potential, so our POP has to be lower. On the flip side, when we sell this, we have a limited profit. Whatever we sell it for is the most we can make. We have an undefined loss. We don't know how bad things can get, which means our POP has to be higher. So let's go back to these trade pages side by side and really take a look at this now. So, is our cost more than our potential profit? It is, right? We are paying this amount of money, $4,555. That's our cost. That's our potential loss. How much can we make? Well, we can make an undefined amount, which means we can make a lot more money than we spent on this thing. It's entirely possible we make a lot more money. And because of that, because our cost, how much we're risking, compared to how much we're making is less, our POP is way down here at 35%. Our risk versus reward, we're risking a relatively small amount with the potential to make a relatively large amount, so our POP has to be less than 50%, and in this case it's 35%. So let's go to the flip side. Our max profit is $4,555 when we sell. What's our max potential loss? Well, it's the exact opposite of the buy side, right? It's undefined. We don't know how much we can lose. And we just saw if the stock went up $100, we can lose way more money than we can win. So what does that sound like? It sounds like trading rule number 1, right? If we can lose more than we can win, our POP has to be greater than 50%. And it is. It's 65. Again, we're risking a lot more money potentially to make a relatively small amount of money. In this case, we're risking a relatively small amount of money to make a relatively large amount of money. This is rule number 1 personified. POP below 50, always. If I'm risking less than I can make, my POP is low. If I'm risking more than I can make, my POP is relatively high. And in this case, it works out to 65 versus 35. That is trading in a nutshell. If we're risking more money than we can win, our POP is always greater than 50%. So even though I've illustrated it a few different ways here, I think we really need to understand why is our POP so different for buying versus selling. And it's going to be for the same 2 reasons, break-even price and time. So remember, in the case of buying options, break-even price and time worked against us. So it should mean in your head now, if we flip it, if we go to the selling side, they should work for us when we sell an option. Okay, so how does that actually play out? So let's look at this. Why is our POP so different, buyer versus seller? Okay, so number one, break-even price. When we buy an option, our break-even price is always going to be higher than our current stock price, which means the stock price must move in our direction. It has to move in our direction. It has to get above our break-even before we start making some money. Not only that, time is working against us. Remember, there's only so many days till this thing expires. In this case, we had 34 days. So buying an option, the stock price must move in our direction, and that move must happen in a certain amount of time. In this case, again, it's only 34 days. So those are the two things working against us. Stock price must move, and time is running out. So if those are the things working against us for buying, it only makes sense they should work for us when selling. Okay, so let's see how that actually works. So we already know now break-even price is the exact same price for both. So how does it work for us when we sell an option? Well, the break-even price is here, $12.60.55. Remember, what happens when we sell an option? What do we want to happen? We want the stock price to go down. Okay, so right now the stock price is only $12.18. So in the case of selling an option, all that has to happen is the stock price just needs to stay below our break-even price and we make money. Well, it's already below, right? Here's the stock price and here's the break-even price. The stock price is $12.18.80. Our break-even price is $12.60.55. We want it to stay below $12.60.55. It's already below $12.60.55. It's only $12.18.80. So that's working for us already. We want it to be below. It starts out way below. So break-even price is working in our favor now. Okay, so how does time work in our favor? Well, if it's working against us when we buy it, it has to move in that certain amount of time. In this case, it's the exact opposite. We don't want anything to happen. So in the case of time, if the stock price move does not happen in a certain amount of time, if it does not go up above our break-even price in 34 days, we actually make money. So every day where nothing happens, it's helping us. Because remember, it just needs to stay below $12.60.55 the next 34 days and we make money. It's already below by a fair amount. And for every day that goes by that it stays below, we make money. So in both cases of selling an option, break-even price and time are working for us. Whereas when buying an option, they are working against us. Again, I think you can see these are exact mirror of each other. Anything that works for us as a buyer must work against us as a seller. Undefined profit, undefined loss. Anything that works against us as a buyer must work for us as a seller. In this case, break-even price and time are both working for us as a seller. And that's why the POPs are so different. So to really drive this POP point home as to why buying and selling is so different, I want to do one last visual representation that really hopefully clarifies it to the nth degree. So the buyer of the option we're looking at as the top chart here and the seller is the bottom. So why are the POPs so different? It's strictly because of this blue area right here. And the reason it's so different is because in one case it's working for us and in one case it's working against us. And what do I mean by that? So here's the stock price when we started, $12.18.80, and here's our break-even price, $12.60.55. So in the case of buying an option, what has to happen is the stock has to go through this blue area all the way past this purple line before we start making money. So you can see it's a big chunk of area here that's working against us. Whereas in the case of selling the option, it's the exact opposite. Because our break-even price is kind of where we're starting, all that has to happen is in the next 34 days in this case, as long as the stock price stays below this purple line, and remember it's already below, it's all the way down here. So as long as it stays below, this blue area is working for us. The blue area is profit for a seller, the blue area is losses for a buyer. And that's why the POPs are so different.